Good morning, Bob.
Good morning, Bill.
We are talking this morning about lots of things, including what are we going to do about servicing, housing prices, and is there enough demand for all of the bonds that are being issued, or too many demands, or too much demand, or how's that all work? And since you're an economist, we ought to talk about supply and demand to start out with, because you economists always come up with equilibrium.
No, I mean, that's exactly the thing. It's finance people who come up with equilibrium.
Is it never an equilibrium?
No, they always think that the world operates at equilibrium, and the economists say, no.
It's always one side or the other?
No, it's all over the place. You know, there's a big space between that supply and demand curve, you know, and anything in between is okay.
Especially with mortgage bonds.
Yeah, exactly.
So let's talk about that. Let's talk about, look, what happened was the Treasury pumped a lot of money.
Huge amount of money.
Not just into Fannie and Freddie, but they did it into TARP too. And Americans do not want to face facts. TARP was very successful financially.
Very successful, yeah.
And yet we don't want to face facts.
In fact, it should have been many times that large. You know, I said something about that.
Well, you did. At the time, it was perceived to be purely political,
yeah.
Except the fact of the matter is, the Congress, when Paulson proposed spending roughly $800 billion,
right.
When he proposed that, they thought he was out of his mind.
Yeah, I know, and it's too bad because, I mean, the basic economics are real obvious, and they've been around for a long time. Nothing's changed except the political view.
Well, okay, so let's step back a second and talk about, let's rewind about 5 years and talk about the political landscape with Fannie and Freddie. Very unpopular having a conservatorship, essentially a bailout, for Fannie and Freddie at the time. Very unpopular. However, you let an American go into a financial institution to buy a house and they want a low interest rate.
They do.
And one of the reasons they have a low interest rate is because of Fannie and Freddie.
Exactly. And you know,
and credit availability.
Yeah, and the GSEs, I think, got a sort of a bad rap. For a long time, the GSEs resisted getting into the subprime market, you know, and they had only just sort of recently gotten into it when things went down.
Thank goodness.
Yeah, thank goodness. And so they did not have the kind of losses that a lot of the big lenders did.
If you just talk about things from a scale perspective.
Exactly.
I mean, they basically backstopped most of the market.
Right, but they stayed out to a large degree. They stayed out of the subprime piece, and that was all done privately, you know, in terms of the private bonds, which no longer exist.
Well, so what happened was you had essentially Treasury coming in through their regulator in a conservatorship and essentially backstopping things.
They did, but that was augmented now. You know, there was a lot of press a few weeks ago about the fact that Freddie and Fannie had this huge profitability right now, and they're paying back the government, and everything's great. But a large portion of that was the money that the Fed was spending and buying all those mortgage-backed securities.
So for our listeners out there to sort of look at the mortgage food chain, a homeowner wants to come in and refinance, or a home buyer wants to purchase a home. They take out that mortgage at their local bank. If it fits in the Fannie Freddie box, the local bank can sell that mortgage, that negotiable instrument, and get their cash back, so they reliquify their balance sheet. Fannie and Freddie then take that basically mortgage, that obligation, that negotiable instrument, and they put it in a pool, and they issue bonds that are backed by that pool of mortgage. Now the demand for those bonds has been going down.
Right.
And so to take up the slack, the Fed has been stepping in and buying those and other mortgage bonds in the marketplace, propping up the prices of those bonds and allowing Fannie and Freddie to achieve, and that whole origination process, and securitization, allowing them to achieve large profits, which they then take and pay back the Treasury.
Right, which is the Fed.
Which is related to the Fed, or to the other side of the Fed.
Exactly.
Okay,
yeah.
And so that's basically what they're doing, is they are supplying the market of funds for Joe and Susie to go buy a house.
Exactly. And now with the Fed tapering, and that tapering is continuing, and it doesn't seem like it's going to change, that taper is continuing, Freddie and Fannie are saying, well, you know, our profitability may not be so great in the future.
Well, the Fed and the taper, people, they're not they've not stopped.
No, they're just buying less.
They're buying less. They're
Yeah.
still buying. They're still playing in the market. They're just buying less, and they're trying to signal to the private market, you need to come back in. We're getting out, and they're not worried about getting rid of their balance sheet. They're just going to let it run off.
Right. Exactly.
And so
Yeah.
over time, their balance sheet will just get smaller and smaller and smaller.
Exactly. Yeah. And so the question then is, where's that money going to come from to replace the Fed? And that's not certain.
It's not certain.
Yeah.
It may not come back in.
Right. In the past, some of the big foreign countries have come in and bought a lot of that.
They have.
But China's getting on sort of hard times right now.
Well,
they've had some major problems.
Absolutely. And they've been a big buyer.
Right.
They've been holding those treasuries as reserves, and that's all fantastic. And at least for us,
Yeah.
if you owe somebody $1,000, they own you. If you owe them a gazillion dollars, you own them.
Exactly. Yeah.
And so that's been our case, right?
Right.
Well, let's also talk about another piece of that puzzle. They're the servicers. So the servicers, it's really sort of amazing. The regulators did not like the actions that big banks took with respect to people that were delinquent.
And then it's more, I think, not so much the actions, but the inaction, the
Or
failure to do anything.
and the lack of consistent
Right.
treatment.
Yeah.
And so what happened was there was this big move to put handcuffs on the banks.
Right.
To keep them out of servicing. And now what they've done is the banks they've signed all these consent decrees and negotiated orders and that sort of thing, and they've had them approved in the courts. So there's been official sanctions and blessings and fines paid, and now the banks have taken those servicing rights. That's a low margin business.
Right.
And it takes a lot of capital to do it correctly. And they have taken that and they've sold those rights to essentially non-bank firms.
Right.
A lot of hedge funds and others.
Well, and there are a couple of them that have really bought a large portion of those mortgage servicing rights and are now facing capacity constraints in handling that. And so now I was reading last week that a number of other smaller firms are coming in to buy up some more of that. But essentially, you're absolutely right. All of that's moving off of the banks, and all these other firms are taking on that role.
I don't think that's what the regulators intended.
I think that they're probably a little surprised at what's going on and how fast it's happening.
It's happened in the span of 18 months to 2 years.
Yeah.
And so as a result, now the regulators are starting to rethink, maybe it was better in the banks.
Yeah, exactly.
Maybe what we need to do is rethink this and get it back in the banks.
And I'm not sure you can put the genie back in the bottle.
It's hard.
That's going to be difficult because those these companies have built up now a structure, an infrastructure to basically provide all that servicing capability. The banks are quite happy to be done with it.
Exactly. It's a low margin business.
Right.
And it takes a lot of capital if it's done properly. When there was no foreclosures, when they were down, we had foreclosures running at the 1% level.
Right.
They could make money. There was consistency. You could do a forecast,
Right.
and you could control your costs. This deal, the pig has gone through the python, and it's been a mess.
Yeah, the foreclosure rates are dropping dramatically. It's something I talked about last week, that the numbers just keep going down, and looks like, in a couple of years we'll be down back to where we were. But the one consistent thing is that there are fewer foreclosures every month than there were before,
Right.
and the amount that's in the pipeline is getting smaller every time.
Well, and so how does all this shake out? Origination costs have gone. If we look at survey evidence, origination costs have gone way up.
Yeah, they've gone way up, and one of the things that people are concerned about is the market. Although the prices of houses are going up, which is great for the people who are in the houses, so that they can get above water.
So if you're long the house,
right,
you're good.
You're good. But it's the interest rates and the prices going up are now keeping people out of the market. Plus the fact that the costs are going up. An FHA loan, for example, even though you only have to put 3.5% down, the insurance costs have gone up enough that it's now more expensive than it was a few years ago.
Right, and the lenders are facing guarantee fees or G fees to the GSE. They continue to increase, although the new FHFA Executive Director Mel Watts has put those on hold until he has a chance to study those. The staff has a chance to study those, And so we're seeing those fees go up, which makes it less and less profitable, or I guess I should say more costly, to originate a GSE loan.
Right. And so,
And the idea is to bring the private sector back into the market.
right, and you know, despite the fact that the prices are going up and the interest rates are going up, the affordability is still at a many-year low. I mean, I don't know, you could say high.
Yeah,
I mean,
I guess
you know,
you're
it's,
right.
but the average, you know, the amount that you pay out of your income, historically, the average has been around 24%. Okay, and now it has dropped down to about 20%. However, for new homeowners, it is at 24%. And so a lot of the new people are being priced out of the market now.
Or they're trading up. Another way to look at that is they may be trading up.
Yeah. Well, I think we're about out of time.
Well, so we've said a lot of words to synthesize this. It's getting more expensive. The banks are getting out of servicing. And next week we'll pick back up on a favorite topic, regulation.
Oh my goodness.
Morning View is done for today. You all have a fantastic week. I'm Bill Rayburn with Bob Dorsey. Goodbye, Bob.